Welcome to this ICMA Education and Training Series, Let's Talk Markets. Today, we will be talking about primary markets and the bond issuance life cycle. I am Ruari Ewing. I am a Senior Director of Primary Markets, covering the underwriter community, and notably Secretary to the ICMA Syndicate Primary Markets Committee.
I'm Katie Kelly. I'm a Senior Director at ICMA, covering the issuer constituents in primary markets, regulatory policy and market practice.
Hi, I'm Miriam Patterson. I'm a Senior Director in the Primary Markets team at ICMA, and I am Secretary to the Legal and Documentation Committee supporting our underwriting community at ICMA. Rory and Katie, I think it's really interesting that we've all come to ICMA from a legal background, and I'm the newest joiner of the three of us. And I have to say, when I joined, I found it really helpful to go on the primary markets course that ICMA runs, because it really helped me to understand a lot of the commercial and operational background to how deals work and how the bond markets work, and not just the legal side, which we're all much more familiar with. But now let's move on to our topic of today, and let's run through some of the dynamics that play out in a mainstream deal for a typical investment grade corporate issuer.
Well, I think, when it comes to what drives choices of funding for an issuer or a borrower, definitely the better and more established the credit is of the issuer, then the more choices there are, right? Beyond that, there are a number of variables and trade-offs which determine what market segment might suit an issuer at a given time. I mean, you might look at it as thinking about trade-offs when you're looking for the perfect house to buy. Is it someone that you want something closer to the tube, you want it to be closer to work, etc. But mindful also that these variables can change, very much over a particular period for an issuer. It can be quite complex, I think, to make the choice, and that's why borrowers or issuers tend to employ underwriting banks to help with the decision making and also to help with some of the execution issues, which we'll probably look at later on. But I'd say there are definitely some key drivers from a starting point. So first of all, the potential investor demand, generally mindful of what's going on elsewhere in the markets and what other issuers there are issuing at the same time. And also which investors are able to match maturity, size, yield, etc. that the issuer is looking for. And I'd say there are also some strategic considerations. I mean, for instance, the issuer might want to diversify its investor base. It might have only ever issued equity or entered into the loan market, so it might want to diversify its funding mix as well. And it might want to tap new exotic, let's say, currencies and markets and become known elsewhere outside of the euro markets. It might also want just publicity for doing something different. So a number of variables. And I guess, Rory, I think the next stage might be once you've chosen what your particular market's going to be, and in this case the bond markets, how would the investors become involved in the process?
Well, I think the first thing is obviously to make sure that they're informed about what's going to be on offer. And what I mean there is actually informed of everything except basically price or the key commercial terms. And in a way it's a bit like a job interview. You go there and you present yourself, you have your CV, you discuss that, and you put that out there. And only once you've actually got the other side interested, then you start talking money. Yeah. And that's a next stage. So just in terms of putting that that CV out there, I think that's where go back to legal points a bit and the prospectus. And so Miriam, how does what's the prospectus role in all of this?
Well, investors looking at deals want to get a lot of the information on kind of a platter that gives them all the information that they need in one place. So what are the bond terms? What is the credit story? What's the likelihood of the issuer honoring the terms of the bonds that they're selling? And who can buy the bonds? So in a lot of countries there are exemptions from a lot of times onerous restrictions for more sophisticated institutional investors as opposed to retail investors. And so a lot of times there are restrictions on who the bonds can be sold to, and that's described and disclosed in the prospectus. Then the banks want to make sure the information that's in the prospectus is correct. So we don't really have raw data rooms anymore where we pile lots of documents in and send all the lawyers and teams into the data rooms. But the investors still need to be able to digest information, and the issuers need to commit a lot of time actually to making sure that the information they're providing can be verified and can be diligenced, we say, by the underwriters and their lawyers. I'd say the invention of the shelf prospectus has also really streamlined bond issuances in recent decades. And so that's a kind of omnibus document, we call a program, where you have all the menu of options that might be available for a bond issuance. And at the time of the bond issuance, you decide which elements of the menu you want to incorporate into that bond. And that document, the program, usually runs and covers all the bonds that can be issued in the upcoming year for an issuer. But after you get the prospectus published or finalized and up and running, you want to market your transaction, and then that means the issuers might need to go on roadshows. Can you tell us something about that, Katie?
Yeah. I'd say, to your point, when you have issuers who are much more established and are very high credit worthiness, then sometimes they might be able to truncate or completely skip the roadshow process altogether. Yeah. But generally, for others, the banks, the underwriting banks, are extremely helpful and help to set up the roadshows and align the investors, etc. Now, in the past, it could have been that your roadshow would have taken anything from a week to maybe 2 or 3 weeks, and would have involved a lot of international travel, a lot of trying to meet investors. So, quite a meaty chunk of work, actually. But as a consequence of COVID, and probably has been the same for many of us in different areas, a lot of the process has moved to virtual platforms. So virtual roadshows can be completed in just a couple of days if you can line up back-to-back investor sessions, which is generally seen as being obviously very efficient in terms of time and expense, and also actually aligns with firms and individuals' sustainability requirements and credentials. So, but that said, I think there is a bit of a movement back towards face-to-face meetings, I think, particularly in some jurisdictions where there might be a cultural expectation of a face-to-face meeting, a handshake, seeing the whites of their eyes. And that can also easily translate into more participations in order books. But the one thing I would say about roadshows, no matter how they're delivered, is it's very important that the information that's given in the investor presentations is in line with and doesn't detract from the information from the prospectus that you've already talked about, Miriam. So, Ruari, looking beyond then the investor roadshows, etc., what is the second stage after that?
So now is when we can start talking effectively money. And so, you've shown what's on offer, you've put out the brochure for the cars that are available, and it's a question of putting out some initial pricing indications. So what will happen is that the banks will put out an initial pricing suggestion and see what reactions they get back in terms of orders from investors. Now, what you might do is you might price, initially slightly generously. So what that means is it's a bit cheaper for investors, and then as the demand comes in, you might sort of tighten that pricing a bit, so that you then sort of start bringing the demand down, more in line with the deal size, the amount that the issuer is actually trying to raise. But also you need to be careful, not to overshoot, because if you start, raising the price too much, the risk there is that investors start dropping out. And then if you start doing a deal where you're actually making things cheaper, that's not exactly a very encouraging sign to get investors back in. And if the whole thing tanks, then what you've done is you've wasted investors' time, and their time is precious. Taking time to study a deal, to do all the diligence that they need to do is expensive, and you really don't want to waste that.
So these price iterations, where do they start?
So it's a challenging thing. It's art, not science. You look at references out there, and that's some of the advantages of involving the banks because they're doing other deals.
Okay.
Ideally, you'd look at secondary trading, see where that is, but that's not always as liquid or as representative or as transparent as we'd like. And the secondary market space that they're working on all of that, but there are challenges. You might look at other new issues which have been recent and comparable, and again, that's a judgment call. Which things are sufficiently similar in terms of the characteristics, the type of issuer, the geography, the industry, the size, the maturity of the currency, and try and sort of work from there. But also you might try and speak to a few investors, usually potentially confidentially, for some thoughts, sounding them on that, and bring that all together. One of the things that's quite interesting is that when markets have been closed recently, new issue markets, because of volatility, then that makes it more challenging because you don't have as many comparables out there to work from. And that's why markets then tend to reopen, the new issue markets tend to reopen iteratively with some of the more safer credits, the ones who are much better known to investors, the ones who do much more simple issuance. Because for them, they'll have a better idea of where to start their issuance, and then that can start building the pyramid of comparables again. Okay.
And what about book updates?
So this is an interesting concept that sort of came in particularly after the great financial crisis, when the issuers and in the deals we were trying to give confidence to investors at a very, very volatile time. And so rather than just merely stating what the fundamentals of the transaction were in terms of it's this size and this price and this is the issuer's credit rating and things of that nature, there was an indication of effectively how popular the deal was. And that's something that it can be a bit of a two-edged sword because it can drive momentum in terms of getting even more investors in. But obviously, if the momentum's not quite there, it can work it's a double-edged sword effectively. So in a way, I think one definitely mustn't lose sight of the fundamentals. If one is a long-term investor, you're interested in the bond itself, not necessarily if the guy next door is interested. If you're a shorter-term investor, then that might be relevant because you're thinking of selling potentially in the short term, and therefore, how popular it is might impact the secondary price in the short term. But again, that's not necessarily the kind of investors that issuers would want as a real long-term stakeholder.
And Ruari, do all participating investors actually get allocations of bonds?
Well, no, and that's one of the interesting things that we are working on a book building system, which is your live pricing a deal to demand, to actual demand, which is one of the great improvements with modern technology. In the old days, the issuer would simply pre-price the bonds to the banks, and everybody was doing a bit of guesswork on how you'd ultimately sell it to the market. And now you've been able to match the demand to the bond, but only to a certain extent. Usually it's a bit like a pop concert. You're still going to be slightly oversold, and in a way you want to be slightly oversold. But that puts the issuer and its advising banks in a quandary in terms of which investors get some. And you go through an allocation process where you're effectively trying to prioritize those investors to build a stakeholder base for the issuer. So you're always mindful that you're might be borrowing again in the markets in future, and you want investors who are relatively long-term stakeholders that But at the same time, you don't just want your existing investors. You want to try and broaden the investor base for diversification purposes a bit. So it's a bit of a challenge there, and it's really, again, art, not science.
Yeah, and it sounds like it could be, rife with complexity. So how long does this book building process take?
So it's interesting because once you've done the marketing phase or not, as we discussed earlier, the actual book building phase, the execution phase, is actually very quick. So it's intraday, basically. You have exceptions which might go overnight, but basically the overwhelming majority of transactions are you open books in the morning with an announcement, you collect the orders through the morning. Sometimes you might even close the book at an extreme in 20 minutes. That's too rushed when the markets are really, really fast. Ideally you don't want that. You want to go through the morning, collect the orders, price towards the middle of the day, and then confirm the allocations, and so it's all wrapped by mid-afternoon, which is actually a very efficient process.
And so, Miriam, to you, after that, the deal's done, right? Or what happens next?
Well, you still need to pay the issuer, and the bonds still need to be delivered to the investor. There are international clearing systems that have been set up, and so the issuer delivers a bond, which is immobilized in the international clearing systems. And actually, this is much better these days when you can email a global PDF bond instead of having pallets of bonds printed on security paper being delivered by armored vehicle, all around different geographies. But that's, but yes, you've got your global bond in the international clearing systems, and then you need the underwriters sometimes have to cover delays from payment by investors, but that's also been a huge improvement to what it used to be when they might have had to cover the cost of the entire issuance of the bond. So after that you get settlement, and that's usually happening at T+5, and final documents need to be executed. The automation might be helping to speed up things nowadays. And settlement instructions are issued, and final formal checks still need to be made. They could be really basic checks, even just bankruptcy filing checks that need to be made at the last minute. And investors are likely also needing to sell some of their existing investments in order to buy the new investments that they have been allocated. So there's a lot of talk about instant settlement coming up potentially in the future, and it's watch the space as to whether that's a solution that's going to be desired by investors and everyone in the community. And actually, there's a lot of change happening in the digital space, from settlement to actual issuance of digital bonds, which is why I think ICMA is really keen to have training and education courses to make sure everyone stays up to speed on what's happening in the fintech space also.
So I mean that's all quite interesting stuff. I mean I suppose one of the things we've talked about is how there've been bankers involved helping the issuers, and I've sort of mentioned it in passing as bankers in the plural. Yeah. Because generally issuers tend to hire several banks for a deal, and I'm just wondering perhaps talking a bit about why that, what drives that, why is that?
Well, I think from what we've heard about the life cycle generally, there's an awful lot of moving parts. There's an awful lot of things that need to fall into place. For instance, on the issuer side, on the legal side, on the bank side, on the settlement clearing side, and then again on the investor side when they have to make divestments potentially as well. So there's a lot of stuff going on, even though it happens quickly. And noting your point about automation, Miriam, which might be helpful in the future. But so it's important to have underwriting banks definitely in the first place. And sometimes you might have transactions where you might have 2 or 3, or you might have transactions where you have maybe 6 or 7. And I think there's a couple of reasons for that. First of all, it's the execution that we've just discussed, and making sure all the moving parts fall into place. And also it helps when you've got a couple of underwriters who are taking responsibility for all these different elements and sharing the risk, sharing the load. But it's also because underwriters can generally ensure access to quite a diverse range of investors. So that's helpful, which then offers a sort of a collective and more robust guarantee of payment. Even if you've got the investors lined up, some of them might actually drop out. Also, widening the base of dealers and underwriters in the first place means that you might have more who would be engaged in your secondary liquidity and your trading profile as well, which is helpful. And also issuers have relationships with many different banks, even on the loan side, and then overlaying into the bond side. So they may want to acknowledge those relationships by having certain banks in the underwriting structure.
Yeah. I mean, interestingly, that in turn, of course, means that an issuer is hiring several banks to work together effectively as a football team. Yeah. And and banks obviously have people have different ways of doing things. And what you don't want is the members of the football team arguing on the pitch. And in that sense, actually the ICMA community is what we do actually on the underwriter side, is trying to ensure that they understand each other's differences and align as much as possible, so that when they're coming to work for the issuers, they're able to work as effectively. And obviously, one can't eliminate every aspect of difference, and the whole point is there can be legitimate different points of view, and they have to be respected. And it's just to make sure that people are aware of them. I mean, particularly bearing in mind that regulation has become so much more complex in recent years. And one of the things is there's a far greater infrastructure of middle office, legal and regulatory support to the underwriting function at banks. And one of the challenges, of course, is to ensure that those middle office support functions understand what the bankers are doing. And again, that's one of the interesting things, an ICMA course which we set up, which is to explain the commercial aspects of underwriting to those legal and compliance functions internally to help them be up to speed and apply their skill set as efficiently as possible on an internal basis.
Yeah.
Thank you for watching. We hope you found this discussion of primary markets and the bond issuance life cycle of interest.